We have a very exciting video to get into here today, all about hedge funds and margin calls and how this specifically is going to play into giving us the MOAS with AMC stock. And there is one video clip that is about 5 to 6 minutes long that I think every single ape needs to hear. This is somebody that runs his own family's firm that is essentially exposing the hedge fund industry and where they currently sit. And I gotta say, I'm even more excited after watching it. So tap, tickle, touch, or smash the like button for all my OGs out there. Thank you guys for tuning in. If you guys want access to all of my trades, you want to come kill it with us, link down below in the pinned comment or in the description of this video, and get yourself free stocks with Webull, Moomoo, and Public. Link down below in the description. So getting straight into this information, forget AMC's down 0.5% today. Doesn't even matter. There is a war against AMC currently going on with hedge funds, and I do want to start off with this article. We're not going to stick on it too long, but I just want to put this move today into a little bit of context. So hedge fund manager taunts apes with AMC short position. Quote, "I dare all the meme stock maniacs to try to hurt us." And essentially he said it was a small position. AQR Capital Management, Cliff Esness, called them out on Wednesday, meaning called out the apes. And I think it just shows the lack of credibility, the lack of experience that you really have to short a stock at $11, $12, close to its fundamental valuation, at a time where money is switching from goods to services, something like AMC. At the same time, AMC's business is in a much better place. There's no comparing AMC even 24 months ago to now. If there was a time to short AMC, you could make the case back then, but it's not right now. So this kind of puts into perspective what's going on a day-to-day basis with the hedge funds and AMC. It's an egotistical battle. Literally the words there. I dare all meme stock maniacs to try to hurt us. That's the logic. That's all the logic you need to know. It's an egotistical battle, even though the numbers, even though the position doesn't make any sense to go short on AMC. And they're going to lose money ultimately when it comes down to it. So that's that, and that really helps to explain what is going on today. Now, the hedge fund industry in general is not in a good place, and I want to go ahead and play this video for you guys now, and then after we're going to go over a couple other key things that this guy really comments on that I want to elaborate on a little bit more. So let's get into it. We will be back after this video.
Could hedge funds be the new canary in the economy coal mine? Well, the performance of Tiger Global, this is one of the biggest hedge funds in the entire industry, down 52% just this year, clocking $17 billion in losses, much of it attributed to huge investments in Silicon Valley unicorns, which have recently floundered, along with the tech sector, right? Then there's D1 Capital Partners, which last year posted a gigantic portfolio gain of 70%. It's now scrambling after down 23% year to date after having borrowed $2 billion to take stakes in private companies whose valuations, you guessed it, have now plunged. And then last month, Melvin Capital's Gabe Plotkin pulled the plug on his fund after wrong-footed short bets on GameStop, among other names. As many hedge fund traders find themselves on the wrong end of the markets, which are either in or hovering around bear territory, is the worst yet to come. Let's bring in hedge fund veteran Raj Rajaratnam. He founded and managed the Galleon Group hedge fund until an insider trading case forced its closure in 2009. Raj now runs his family office, Cinnamon Global. How much worse is this going to get? I mean, these are just a couple of names that have reported their very bad performance.
Yeah, I think it's going to get a lot worse, Liz, because what I'm astounded by is the lack of risk discipline in these hedge funds. We talk about asset bubbles in meme stocks. We talk about bubbles in SPACs. We talk about bubbles in cryptocurrency. But these are supposed to be some of the most sophisticated investors. And the reason people give 2% management fee and 20% incentive fee is to manage the risk in down markets. What we've seen is that the large hedge funds, long-short equity hedge funds, have got into SPAC investing, have got into private equity investing, got into venture capital investing, which is not their traditional expertise, and they're borrowing money. So when the market turns, they're not able to be flexible and move quickly.
What amazes me is people, as you say, are paying these guys to be much smarter than the rest of us in the room. And look what is happening here. When the markets flip a switch and the tables do turn, that's when, as Buffett likes to say, you see who's been swimming naked as the tide goes out. Well, I know you can't name names, but what types of bets have gone so wrong way that we will start to see some hedge funds that have made those bets maybe go under?
Well, if you're down 50%,
5-0.
5-0, you need to make another 100% on your capital to get to break even. So if you start at 100, you go to 50, now you have to double the 50 to get to 100. So there's going to be a lot of hedge funds that are under what they call their high water mark, and they're not going to work for free, so some of them will close down and possibly restart again.
And then their investors come knocking at the door as well. It just starts falling like dominoes, saying we want to pull our money
out. So I think there are a whole bunch of hedge funds that will close shop, either because investors are taking money out or because they don't want to stay the course. So the most important thing to be a hedge fund manager is to manage risk. And that's why investors give you the high incentive fee.
Hence the term hedge.
Hedge,
You're supposed to hedge. Let me ask now, they also are getting another stumbling block thrown at their feet, and that is the potential rule change to trading that Gary Gensler, the Securities and Exchange Commission chair, wants to make. Hedge funds make massive block trades. How do you foresee his changes potentially involving things like ending payment for order flow practices affecting hedge funds, and quite frankly, could any kind of contagion spill over to the retail investor?
So this payment for order flow is mainly aimed at the retail investor. Today, the retail investor accounts for about 20% of the trading. So firms like Charles Schwab, E-Trade, the big retail brokerage firms, Ameritrade, Robinhood, they shop these orders to a firm like Citadel or Virtue, and they get paid for that order flow. In fact, these brokerage firms last year made $3.8 billion paying the brokerage firms for order flow.
Right.
Now, what you do if you're E-Trade or Charles Schwab, you give it to your favorite execution broker. And while the public thinks they're getting no commission, they're not getting the best execution price. So there's commissions built into the system. So I think it's a great idea that Gensler is trying to make it much more competitive and put it into an auction system. But knowing Washington and knowing the lobby of the brokerage firms, I'm not optimistic that anything will get done in the near future.
Well, you are running money for your family office. The markets have been very hard to anticipate. What do you see as an opportunity right now, Raj?
Yeah, so we invest in disruptive technologies. And we've been very cautious on the market. It's a very, very challenging year this year. What we are seeing now is the valuations have compressed. And what we are doing is looking at companies or sectors that are somewhat recession resistant. So there are three sectors we've identified. One is cybersecurity. Every day, people are trying to hack companies in the United States. We look at cloud computing, which is important, and electric vehicles. This trend towards clean energy and electric vehicles is a secular trend. And within that, we have companies that we've invested in.
Good to see you, Raj. Please come back, because I know this hedge fund story is far from over. A lot of them may start to fall and stumble and then outright pull the plug. Raj Rajaratnam, good to see you.
A lot of them may start to fall and stumble and pull the plug. I think that's a great way to end off that segment. What she said, because I think that is very, very true. And where we currently sit with the hedge fund industry, as you guys know, a lot of hedge funds have really bad returns. They're not doing good, right? They talked about it in that clip, and those are only some of the larger funds that have actually expressed how they're doing. Not all funds have actually done that, and now that we are ending off of Q2 here very, very shortly, you're going to start to see more hedge funds come out with massive losses, and you're going to start to see more redemptions as well. So hedge funds brace for $20 billion of redemption. Citco says this was for Q1 of 2022. It says only 40% of hedge funds globally made money in the first quarter, compared with 61% in the previous 3 months. Now, why this is so key, and what they talked about in that clip, was if you're a hedge fund, the reason why you pay a hedge fund those fees is so they can make a return even in a down market. And it makes sense if you're somebody that can find a good hedge fund to do that if you have a lot of money and you don't have time to manage your assets for you. For an example, if the S&P on average returns 7% per year, but some years it's up 20%, some years it's down 10%, well, if your hedge fund could just return 10% per year in a good or bad market by hedging, well, you're still going to beat the overall markets. Even if you paid a 1-2% fee, you would still make more money than the average investor. That's the theory behind a hedge fund. But obviously, when it does not work that way, what happens? Investors want their money out. They say, hey, well, I'll just put this in an S&P 500. I'll take it to a different hedge fund. I'll do whatever with it. And that's where you start to see redemptions. That's where you really start to see margin calls. And when these hedge funds get redemptions, they have to essentially get rid of some assets in their portfolios. And it's not always the hedge fund's choice which assets they do get rid of, especially when cost to borrow rates are so insanely high for AMC. Even today, the cost to borrow rate is now 49.5%. That is absolutely ridiculous. But at the same time, look at this. Bridgewater doubles short wagers in Europe to $10.5 billion. Hedge fund manager has short positions against 28 firms. Ray Dalio's firm ramped up its bets in the past week, and this just came out as of yesterday. What did Ray Dalio do, though? He actually bought AMC stock for the first time. He actually doubled down on his GameStop position as well. So I think it goes to show the egotistical battle that we are seeing. And really, hedge funds right now, they're in a lot of pain. There's a lot of pain across the board. If Tiger Global's down 52%, you can imagine a lot of other hedge funds are down much more than that. These hedge funds have gotten greedy over the past 2 years. While we didn't expect 2022 to be a great year, nobody expected 30% down in the NASDAQ, and likely by the time this thing is said and done, the NASDAQ might fall as far as 50%. In my personal opinion. Now, the last thing that I do want to talk about here in this video to tie all of this together is really what we have seen in equity markets compared to what we are seeing with the margin debt. So margin debt as of January 2022 was sitting at $829 billion. Well, now as of May 2022, it's sitting at $753 billion. The margin debt has not come down all that much in the grand scope of things. Let's go ahead and do the simple math here, since I have not done the math on this so far. 829 minus 753 comes out to $76 billion worth of margin debt that has been taken away. That is roughly 15% reduction in the amount of margin debt for 2022, whereas the NASDAQ is still down close to 30%, even after this slight rally that we have seen over the past couple of days. Still down dramatically. So what is essentially happening is when we do get that flush out, when you do see the markets finally realize that the Fed is going to raise rates during a recession, at the same time there's quantitative tightening, at the same time China wants to invade Taiwan, Russia is at war with Ukraine, and everything else bad going on in the world, that's when the markets are going to say, shit, the Fed is not going to U-turn, because the markets right now expect if we go into a recession, no matter where inflation is, the Fed will slow down. The Fed is not going to go even more aggressive once you're in a technical recession. Well, I argue that is not the case. If inflation is 8% by July 28th, if we go into a recession, the Fed is still going to raise rates as aggressive, if not more aggressive, because of it. Because ultimately we need to get rates up, we need to get inflation down, and those rates going up allows the Fed to have more leeway and to cut rates to accommodate the markets. So I argue the Fed is going to say, hey, well, unemployment is still very low, so we don't have to stop raising rates. Yeah, we're in a technical recession. They're going to blame it on other factors. We don't have to stop raising rates, and we can't stop raising rates. That's when the markets freak out. That's when the margin calls come. And that's when you're going to see massive liquidations of hedge funds. And I will fucking mark my words right now. It is June 24th. By July 28th, we have the Fed meeting on July 27th. The next day, we will get the GDP report, and the Fed is not going to U-turn on July 27th, and we're going into recession by July 28th. That's when the markets freak out. That's when you want to have your puts ready. So that is going to be all for this video. If you guys didn't catch something that was said here in this video, especially in the last couple of minutes, go back, rewatch it. Thank you guys for tuning in. Hopefully you find value out of it, and hopefully you do catch the flush to the downside on the head and you're able to make some money off of it. If you guys want access to all my trades in real time, we will definitely be trading that event. It's going to be massive. Link down below in the pinned comment and in the description of this video. Thank you guys for watching, and I will see you in the next one.